Wanted to take a look at the stock market today after a huge day yesterday. What's going on? What can we expect next for the stock market? Now, I've been saying for some time that the Federal Reserve has been lowering interest rates too soon, too fast. We got word yesterday from the Federal Reserve after the meeting. They did lower interest rates, of course, but are not going to lower interest rates or not looking to lower interest rates as much as anticipated in 2025. So anybody that's been following my videos, I've been consistent as can be. This economy is very strong. We have a 4.1% unemployment rate, and this is helping to drive up price pressures. Price pressures are not hitting the 2% target rate. In fact, we just got CPI data the other day that's suggesting that prices are starting to become more robust. So assessing what's going on with the economy now, which would affect the stock market, you have to look at all these different parameters, and I have a new chart I want to show you that could be a saving grace for the economy right now and the Federal Reserve, and it is the Federal Reserve balance sheet. It's not growing as rapidly, and that could help the money supply. That is the key right there, the money supply. I'm going to break all this down for you in charts so you can logically follow along, sit there and say, wow, okay, I can see everything. Then we get to throw it all out, because on January 20th, there's a whole new paradigm shift. So on the one hand, you have to assess what's going on, what expectations are for 2025. Then you have to account for a whole new dynamic. This is going to be an interesting balancing act. And so the Federal Reserve is going to have to look at what's going on now, then add in the future with the Trump tariffs. I look at Trump, and this is my honest take. His policies are horrific for an economy that wants to continually expand. Economists genuinely believe that a continually increasing economic output is good. But the problem is simply this, and this is the philosophy. The economy has expanded so much, it's left too many people behind. Trump's sitting there saying, I'm just going to burn everything. So everybody at the middle will be pulled backwards, kind of bringing back down to the lower end based on this. It's going to be an interesting paradigm. Let's see how it plays out. Regardless, I'm going to make money in the stock market based on Trump. Let's jump in and I'll show you some charts. Here we're taking a look at the US 30, the Dow. And you can see this slow grind lower and lower and lower. A little bit of a sort of bump there just before the Federal Reserve meeting ended in the press conference, then a flush of the toilet. 1135, I think it was the total number that it fell to close for the day. We are looking at 10 solid days, which the Dow itself has not had 10 negative days straight since 1974. This is still a solid 3-4 hours left in the trading day today. So who knows what happens in the next couple hours? It could come. Traders could come in and start selling again. The Trump bump itself on the Dow all but erased nearly. S&P 500, a little more broad look at the overall economy. Still up higher. NASDAQ, which is less sensitive to interest rates, is much higher as well if you've taken a look at those charts. Here is the U.S. 10-year Treasury yield. Now, I've said repeatedly, you can go back in all my videos regarding, say, TLT stock, TMF stock, the ETFs for Treasury prices. I'm long on TLT. TLT, of course, I started getting in about 78, I think was my first initial pull of the trigger. It's just below 90 at this point. And I've been saying that I don't think the U.S. 10-year Treasury is going to go too much higher above 4.5. I don't see 5, given the information we have today. We have a new paradigm on January 20th, of course. And a lot of people are following me. Anytime I put up a TLT stock analysis, those videos do very well. Given the assessment, I don't think the Federal Reserve should have lowered interest rates as quickly as they started back in, I think, July. They've since lowered interest rates 1 full basis point to get to a more neutral stance. We have an economy that is producing inflation, the CPI core rate, well above the 2% rate. I've got that chart here in a second. Does not look like it wants to come down. Kind of moved higher, the last report. If we see another move higher, or 2 or 3 more consistent numbers in the core PCE number or CPI, that would be game over for the stock market, plain and simple. But we keep having to look forward to January 20th, so it's going to be quite interesting. In the meantime, here is the month-over-month core PC inflation deflator. And as you can see, it's a little slightly elevated. If we see numbers at, say, 0.2, 0.25, 0.225, somewhere in that range over the next 2-3 months, that would be problematic for the overall PCE inflation deflator. The reason why is if you hit 0.3% month over month and you do that for 3 months without compounding, that's 3.6% annual inflation rate. Compound it. You're starting to push at 4. So anything close to 3, it's going to get real ugly for the overall stock market because the thinking is simply this. Price pressures are too high. The Federal Reserve lowered interest rates too quickly, and they need to, at the very least, keep interest rates higher for longer, which will be punishing to consumers. Here is a look at core PC inflation deflator year over year. The previous chart was month over month. You can see just a slight trend higher. And I don't think we're going to see this thing moving lower given where we are. The unemployment rate's at 4.1%. We're at full employment. Consumption, personal incomes are moving higher and higher. I also wanted to take a look at the money supply, and I've been bringing this chart in. I've got another chart, the Federal Reserve's balance sheet, and I'll show you that to you in a second. The money supply is the fuel that keeps this economy moving forward. Take a look at this. The year-over-year growth rate of the money supply, despite the fact that the Federal Reserve had reduced or increased interest rates as much as they have, they've simultaneously reduced their balance sheet, which shrinks the money supply. But the money supply continues to grow, and we're getting back closer to the median level. I don't expect the median level to be hit, and then we see a flatline growth rate in the money supply. This thing is a moving train that they need to stop. Money is fuel. We are in a fractional banking system. If we're seeing this kind of growth rate, that tells me that at this pace, money is inexpensive. That businesses believe they can go ahead and borrow money, which at this point, say it's 4.5% on the 10, they can borrow that thinking that they can return a higher number in the future. Money is too inexpensive, and that's why fractional banking, they're creating more and more money as banks are lending more and more, and I'll break down more of that in the next coming months. But here's a look at the M2 money supply versus core PCE. I inverted core PCE. It's sort of a kind of an economics thing where the inverted rate shows you that as the money supply increases, inflation moves higher as well. The money supply is moving higher. Plain and simple. What will happen to inflation? What would push the Federal Reserve to raise interest rates? Higher price points continually. Now, here's the Federal Reserve balance sheet. This is the other way that money gets created here in the United States. You have the fractional banking system. A bank is going to sit there and say, well, we've got X dollars sitting in here in reserve. We don't need this much. Let's lend some out to worthy borrowers. Let's charge them this amount. Those borrowers are lining up basically We could see how in a fractional banking system this is happening. At the same time, the Federal Reserve is the only sort of entity in the United States that can just invent money out of thin air. They did so in a major way. You can see these numbers where the balance sheet, they just basically said, we're just going to create money. They're the only entity that can do that, and they did. That was all COVID. Fed stepped in and just started inventing money, buying assets to inflate the economy. We're paying the price. Now they're removing all that policy accommodation, which is also quantitative easing, QE4, the nickname on that. This is hard to kind of quantify. Sure, the number's going lower, but this gives you, this is the same exact chart, but a year-over-year change, rate of growth. So we're seeing the money supply or the balance sheet for the Federal Reserve moving lower, negative growth. They're shrinking their balance sheet, which they should. This should reduce the money supply itself. And if we take the two charts and overlay them, you can see that the Federal Reserve balance sheet and the money supply, they kind of go hand in hand in extraordinary ways. Given this, we're looking at various things with regard to how this plays out. My take is the Federal Reserve needs to reduce its its balance sheet faster, which would halt the growth of the money supply. That would help balance out price pressures. At the same time, if they kept interest rates higher for longer, this would reduce borrowing. Simultaneously, there's a third effect. Businesses are going to start to see a slow grind lower, and then they're going to go ahead and start firing people, laying people off, because businesses are going to cut their costs because revenue growth rate isn't as big as it could be. So this is how this all plays into each other. Then we got January 20th. Probability of U.S. recession. I did a video on this just, Monday? You can see the probability of recession hit, I think, 0.71, which is 71%. It was just over 70%. If you look at what we've got going on here, this basic chart has never really been wrong. The timing was off in the 1960s one time. Outside of that, we've basically had a recession anytime the probability expected a recession. And so the way this works is the yield curve. When the short end goes higher than the long end, this activates that sort of probability factor. And from this, this comes from the New York Federal Reserve. They take a look at the 10-year minus the 3-month. And this is how they indicate whether or not there's a probability factor involved, and what that probability factor is. There's always a probability factor. And as you can see, sometimes it's really close to zero. We don't know what's going to happen 10 years from now. So if you take on a loan of any kind 10 years out, there's risk involved. And so there's a risk dynamic, how much you have to pay for that risk. That would be, of course, the rate of interest. We have a pretty good idea what's going to happen in the next 3 months versus more so the 10-year. So when you subtract the two, there isn't as much risk in the short term as there is in the long term. So on the yield curve, the short months should be lower than the long months. But that's not the case right now. It's inverted. The 10-year minus 3-month is negative, and it is moving higher, of course. But the 10-year yield is still below the 3-month. This is an unnatural curve. The Federal Reserve needs to get to the most natural curve while at the same time balancing price pressures and full employment. It's not easy. And again, we look at one big factor coming forward. That, of course, is Trump. Trump says he's going to go ahead and hit 25% across the board for Canada and Mexico. Tariffs. No reason. He's he's just going to do what he's going to do. He believes that manufacturing will come back to the United States. He's absolutely right. If you raised tariffs high enough, eventually we will stop buying from these other countries. But are we a worse off country because we're paying less to another country? Well, that all depends on your philosophical sort of outlook on life. Here in the United States, you got states. I live in Santa Fe, New Mexico. The minimum wage here in New Mexico is $15 an hour. In China, it's like $1.50 a day. So if you can manufacture something where the employee earns $1.50 versus $15 per hour plus benefits, what are you going to do? So in order to bring this manufacturing back, you have to unnaturally raise prices on everything across the board until it gets to the point where manufacturing returns to the United States. Who wins in that? Everything is going to go up in price. In the beginning, it will go up 25%. China, of course, they're talking about 10% across the board. Mexico and Canada, 25%. Who wins in that? Would it be better to pay less for an item or more? That's basically what you're asking. You only have a small amount of money that you earn, small, whatever it might be, it's all relative, in any given period of time, whether it be an hour, a day, a week, month, annually. Whatever you earn, that's a finite amount. So if everything moves higher in price across the board, you can only buy less and less. The thing is with this, these are tariffs. So who gets that money? The United States federal government. What else is happening? Trump is going to more likely than not extend his tax cuts. From 2018, they went into effect. They expire in the next 3 months. I'm not sure if it's January or March. I've heard both numbers and I've never really looked. That creates a deficit because corporations don't have to pay as much. It was something like 1.5 trillion for these few years we've had before. Now they're looking at it saying it's going to be closer to 4 trillion for the extension. So somehow that gets paid, that needs to be paid. Otherwise, interest rates need to remain higher for longer. Make the people pay for it. Get those people on their hamster wheels, run, run, run. So basically what you have is 350 million people, less that 1%, running on their hamster wheels to pay for corporate profits. Whether you believe this is a good thing or a bad thing, this isn't a philosophical debate. That's what's going to happen. The question becomes, how can you make money in the stock market because of that? Do I think this is a good idea? It all depends. What do you want? In this case, Trump, who's filling his cabinet with billionaires, is looking to grab everything they can. Cool. As long as I'm not one on the hamster wheel. That's my take. I will be making what I don't earn elsewhere, I will make in the stock market. I'm going to earn that money in the stock market. That's how I look at it. Others don't have that opportunity. Get your running shoes out. Get on that hamster wheel. So you've got these tax cuts. You got the tariffs. It's just a transfer of money. In the meantime, this will grind the economy lower because incomes are finite. At the same time, every price moves higher. So while the Federal Reserve is now dealing with sort of a 1-2 punch with higher prices, they get the benefit of a slower economy with higher unemployment, if you could call it a benefit. Short term, prices go higher. Long term, the economy contracts. People become unemployed. But the billionaires get their money. Okay, how do I get mine? That's how I'm looking at this. It's going to happen. Do I like it? I don't really care. I look at it as the opportunity it is to make money in the stock market. So this is the paradigm shift we get to see starting January, purportedly, if he keeps his word and actually jacks those tariffs up like he says he's going to. There's going to be huge retaliations from both Canada, Mexico, China, everybody. It's just going to be a war. If it gets to be a bloody war, the U.S. economy will suffer drastically. From that, you can make money in the stock market. As for what's going to happen next with the Federal Reserve, this is not going to be an easy, slight transition. Just as COVID was an immediate impact to the economy, so will those tariffs. The Federal Reserve is going to have to act proportionately in order to maintain its objective, maintain price stability and full employment. How the Federal Reserve does that going into the future, first we actually have to see, are we going to get those tariffs? Otherwise, at this point, given the information we have, the Federal Reserve moved too fast, too soon. I've been saying this for months. Now we're seeing it play out. I also said that I thought we would see a big sell-off October, November, December of this year. We got the Trump bump. Now we're getting a Trump dump. That Trump dump is going to get worse and worse after January 20th if we get those tariffs. So this could be a long slide lower where savvy traders have taken their profits and are running. The least savvy will take their losses later on. We'll see how that plays out. Regardless, I will consistently bring in this information and my analysis as to what plays out and how to make money in the stock market. Whether I think these are good ideas or bad, it all depends. I will never give you a yes, no, good, bad. Things will move. Then you get to make money in the stock market. See you in the next video.